tell you, as I was listening to our guest today, Robert Pereira, talk, it made me realize or discover, if you will, that I need to be spending way more time around operators, the people who know how to do things, man. It reminded me just of whenever we interviewed Alex Hermosi on our podcast. And he was talking about how when he wanted to get in the gym business, what did he do? He went and interviewed the 3 top gym people out there. And after talking to them, he asked them the question, who would be the 3 people, if you had to refer someone out other than to work with you, who would you tell them to go to? And he's like, this is exactly what we did when we work in the government business. If we wanted to get in a new industry, we would always go find who are the top 3 people in the industry. We'd ask them every question that we needed to know about what they did, how they did it, why were they excellent? And then we would say, who, if you had to refer out other than yourself, would be the 3 people you would refer me to? And we would go do the same thing with them.
Well, what you're talking about, Russ, is really like the subject matter expert. At the end of the day, you listen to podcasts like this to get mentors, to get people to cast vision and give you the why behind everything. But in order to really turn decades into days, you have to have the subject matter expert giving you the how. And today's subject matter expert is Robert Pereira. And Tribe, if you've been thinking about investing in multifamily, this is your episode, because he's going to unpack for you the 3 reasons why he foresees multifamily investments that might fail in the next 5 years. You're not going to want to miss how having the right debt, being overly optimistic about net growth in rent, and bad operators can really fail your investments. Let's not take any more away from this interview with Robert Pereira.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Wealth Without Wall Street Tribe, it is my pleasure to introduce you, Mr. Robert Pereira, to the show. Robert, so glad to have you, my friend.
Thank you, Joey and Russ. Looking forward to an awesome podcast.
Yeah, man, you're in for a treat, Tribe, because our guest today, Robert Pereira, is an expert. I'm talking about absolutely passionate, dynamic when it comes to everything in the multifamily space. And you're going to hear that. But Robert, I just got to, since we're friends, right? We're mastermind members together. I'm just not going to give you softballs. I'm going to come at you today. I want to I want to talk about why multifamily is not going to be so great, why it's not going to be so rosy over the next 5 years, because all I hear is why it is so good. So if I can challenge you, why, if you could think pessimistic with me for just a second, why do you believe, if any, multifamily will struggle in the future?
Absolutely. I can give it to you. And I'm going to lead from a position of saying that I think on the go forward, right now, and as we go forward over the next 12 to 18 months, there's going to be some really great deals to be purchased. But I'll tell you why I think multifamily deals are going to suffer, especially the ones that have been bought in the last, call it 2 years. Okay. 3 main points. One is one involves debt. The second one is the projections as far as income growth. And the third one is just poor operations. So first, to speak of debt, in starting with COVID and onward, once we got this big influx of capital into the country, we saw a lot of lenders that were willing to lend on deals that probably shouldn't have gotten the proceeds they got. So, they were overextending rather than having more equity in the deal, which would have put a smaller loan to value. We've got some loans out there that are a really high loan to value, from when the deal transacted.
And hold on, I just want to make sure I know what you mean, but I just want to make sure people are following us. When you say that, let's just say it's a
$20 million deal, that probably should have gotten 12 million of debt, got 16 million of debt, and the equity made up the difference.
So they're borrowing more than they should have against that asset.
Exactly.
Okay. All right.
And the reason the lender did that was that there were very rosy projections on rent growth. So they're like, okay, we're lending you guys more than normal, but we think you guys are going to have an asset you're buying for 20 million that's going to be worth 30 million in 24 months. So there was very rosy projections, not on all multifamily, but on enough that I think it's going to be a problem, especially that in the C class space. Like when I say C class, I mean really workforce housing built in the 50s, 60s, 70s, early 80s. I think we're going to see some real distress there where people just didn't have the right kind of debt that is now expiring, where the lender's like, hey, we need to be paid off, which means that if you're still owning that multifamily asset, you need to have a new lender come in and replace that existing lender. That new lender is going to say, well, I know you've lent on this scenario we just mentioned, Joey. We know the previous guy lent 16 million on a $20 million asset. The asset today, you thought it was going to be worth 30. So when you refied, you'd be fine. It's now still worth 20. It might be worth 18. And we're going to lend to you at 10 or 12 million. And then the operator is going to say, well, how do we make up the difference? And the new lender is going to say, I don't care how you make up the difference, but you make up the difference. Go out and raise more capital. It's not going to be easy to raise capital for a deal that's underperforming. So a lot of those deals are going to have to be sold. And when they get sold in a market where they're underperforming, the equity is not going to be made whole.
So, Robert, are you saying that everybody still, familiar with some of the ARMs, right? The adjustable rate mortgages that they did on homes, especially in the early 2000s, that was very, very common. Are you saying that that's the way most multifamily projects are created? They're not created on like a 15, 20, 30-year fixed rate?
Great question, Russ. No, you're typically you'll be lucky to lock for 5 years. And, in some cases, they've got 10-year programs. But the reason that multifamily operators, the debt market isn't set up like it is in residential where you can lock for 30. It's typically 5 or less. And part of that is because the debt market in residential is also very forgiving. If you choose to sell your home, buy another home, you pay off the loan, there's no prepayment penalties. With multifamily, the way it's structured, if you will almost always have prepayment penalties that are involved. So if you finish your business plan in 2 years and you took a 5-year loan, you might have to make up the interest payments for those remaining 3 years as part of your sale, and that'll come out of your sale proceeds. And so sometimes operators will be stuck in a deal because of the debt not maturing for another 2 or 3 years. So it's an art more than a science as far as how to plan that debt. Still better to be conservative than aggressive. And the reason deals are going to go bad and south is because people got very aggressive. The lenders as well as borrowers in the last few years.
So not only are they having mortgages or terms on their mortgages, existing debt that are coming due, but because we're in a significantly higher interest rate environment, what is a tip? Like, take me back 2 years ago, whenever you were doing deals, what was a typical 5-year mortgage that you were getting out there as compared to what does it look like today? Like, how big of a difference is that?
If you were doing a bridge loan, which is often the type of loan that you're going to get when you're doing a value add, you're going to get a loan that has, in order to get more proceeds, you'll work with bridge versus agency. Agency is fixed rate debt that doesn't always, and typically will not come with a capital expenditure component. So if you're buying an asset for $20 million and you want to spend $3 million on it to improve it, the bridge lender will actually give you those construction funds in addition to giving you the down payment funds. Fannie and Freddie will not. They'll just give you the down payment funds. So you've got to raise additional capital, which might prove to be the prudent case. But the last couple of years, the bridge market's been very powerful and has been very comparable in pricing to Fannie and Freddie. That has changed as interest rates have gone up because the bridge market is typically always pegged to SOFR.
All right, hold on 1 second. I want you to use that example that you started with. It's a $20 million asset, and let's say it is a value add. It's something that you want to go in and make improvements to this property to force the value up and so on and so forth. Give me an example of how that bridge loan would work versus if somebody went in and just did the Fannie or Freddie, the agency debt, as you're mentioning, is more of a fixed rate. Perfect. Explain it in that case so that we can kind of understand what you're saying.
Awesome. So on the $20 million scenario, a bridge lender might have lent you $15 million of down payment proceeds and another $3 million of capital expenditure proceeds. So if you're buying a deal for 20 million, it needs another 3 million of improvement money. That means 23 total. The bridge lender would have given you 18 of the 23. You only had to raise 5 from equity. Fannie and Freddie might have, instead of, because it didn't have enough income day one, they're going to be more conservative always typically over bridge lenders. They might have given you 13 million out of the 20 million for down payment proceeds and 0 capex, construction proceeds. So instead of raising 5, you have to raise 10. And since the way deals are structured as far as the IRR, if you're raising twice the equity and it's the same exact deal, your IRR is going to be cut in half. So
and talk about
IRR becomes a 10 IRR.
Yeah, and talk about then the difference between how those interest rates and the terms would be on the bridge loan versus the agency debt.
Yeah, so while there were very comparable interest rates, and let's say in the 3s and 4s 2 years ago, between agency and bridge, today if you're getting bridge, you're going to be in the 7s and 8s. Agency is still in the 5s and low 6s, but it's still lower proceeds. Agency will almost always be lower proceeds, which is fine if you've already raised the income in that asset to support. Because if the income goes up, then your proceeds in general will go up because it's all based on how much debt service you can cover, and the debt service coverage is based on how much income the property has.
But just to clarify one last thing, and I'm just trying to tie it back to why these things can go bad. If you started with that bridge loan financing 2 years ago in the 3s, that was never locked in at 3.
No,
right? It will continue to rise as the rates went up.
Absolutely.
To in the 8s right now.
Well, you might have bought a rate cap, Joey, that might have capped your rate. Instead of being in the 3s, it might have floated up to a 5, which is fine. You're still probably able to make things work 2 points over. But when that rate cap expires, which it typically will 2 years after you initiated the loan, then all bets are off because you've got to either buy a new rate cap, which will be much more expensive than the rate cap you bought when you acquired the property, or you have to refinance. No matter what, it's a balloon situation, right?
Gotcha.
And the balloon's going to pop if you don't have the value.
But that's the reason I wanted to bring this up, Trav. I hate to be negative on anything, right? But I want us to be diligent in our focus, right? Financial freedom is when we have more passive income, we have monthly expenses, but we also have to be looking forward to how do we avoid the expenditures, like losing money, right? That puts us where our passive income goes down, yeah. Right? And we still have the same amount of expenses. So we're getting further away from financial freedom. So if we're in deals, we need to be asking our operators these questions, like what are the rate caps that you have? How long are they in place for? How well prepared are you for the rate increases that may happen? Are you going to be able to sell the deal before the expiration? Like preparing yourself for some of these type of things. So one thing, Robert, one reason you're giving us as the reason why deals may go bad for existing properties is because of rates. What would be another potential thing that you could think of that would cause deals to potentially be going bad over the next few years?
Great question, Russ. So directly correlated to like the debt is the reason the lenders were lending aggressively is because they saw optimistic rent growth. That rent growth has actually been achieved in assets because we've had rampant inflation. I've seen it. I mean, we own assets where we've owned them for 18 months and the in-place rents the rents we're achieving are 30% higher than they were when we bought. And inflation's not up 30% in the last 18 months, right? So what I'm getting at is if you've run your assets well, multifamily operators have done fine from inflation. It's if you bought poorly or you don't operate well to actually be able to get that rent growth, you're not doing the improvements to the asset. It's not looking any better. You're not improving the safety of the people living there. There can be a myriad of reasons as to why your asset's not getting the income bump that you had put into your projections. If it's not, then you're in a position of having, overly optimistic projections, which even if the debt wasn't an issue, the debt will add to the issue. But in general, when you're trying to do something in value add, you have to add that value. And that value is, do the work and then the income grows. If the income hasn't grown because you were overly optimistic or had bad operations. So when I say bad operations, I don't mean not collecting the money. I mean, you hope that you've got property management that can at least collect the rent. But I'm talking about drilling down into the operations. How well are they actually improving the asset? Are they spending well on the construction of improving units or common area features like a clubhouse, the pool area, pool equipment, furniture, that kind of stuff? That granularity matters to the renter, right? And that's going to be the reason a renter is going to pay $1,000 versus paying $1,100, and that $100 delta can make a big difference in your business plan.
Okay, so before we get too deep into like the operation side, I want to go back to the rent growth factor. So, is any part of that, whenever someone's buying an asset, they're trying to underwrite it? Do you feel like some operators have just gotten to the point where they weren't really that closely following the rent growth projections? They were just basing it off of inflation instead of like, hey, this is already undervalued and there's already room just current market, versus are they just kind of throwing it to the wind and saying, well, I mean, inflation is going to take care of this, and they've just kind of inflated them? Is that what you're saying?
You're absolutely right. Here's why, Joey. Multifamily as an asset class is a fairly boring asset class. It's not a place people should lose money, right? In my opinion, they're not going to double their money in 12 months, and we know that double in 12 months usually doesn't work out anyway. But the double in 5 years, which is what we project at ARC, is a reasonable projection. But what it boils down to is how carefully are you actually evaluating the assets you're buying? What's happened in the last, call it 10 years with crowdfunding, is you have a sponsor that is based out of state, that is raising capital from his network out of state, and they're buying, like, someone who lives in California is buying. I live in California. I split my time between California and the Southeast, but I reside in California. But I have a team that's headquartered in Atlanta that is on our payroll that I've worked with for years now, that are subject matter experts at evaluating rents relative to the comps. And so if you don't have that expertise local and using third-party property management who might be getting your business once you buy as your bellwether, that's a recipe for disaster, because they're not going to be as careful as your own people will. So my people will go in and look at every asset that we're looking to make an offer on and really look specifically at the comps, drive the comps, spend time at the properties, talking to the comps management about how well they're leasing up, what kind of concessions they're offering. When you get to that level of detail, you'd be hard pressed to actually be overly optimistic in your underwriting. And I think that's the problem. If instead of having people on the ground, I was trusting the brokers, or just third parties to do that kind of work for me, and I was just happy that I'd raised the capital and we're going to buy something, then it's like it's a kumbaya thing, right? It's like, okay, let's just hope that it all does well. On the other side, I think, if you really do your homework ahead of time, the odds of a bad outcome as far as overly optimistic rent growth is very muted. You're not going to get that if you're on the ground.
Hey, so I do want to ask, what is a realistic expectation for someone investing in the multifamily space over the next, say 5 years? I heard you just said, hey, we expect to double. So the rule of 72 would tell me that's a little over 14%. Yep. Is that what you believe is a realistic expectation then?
100%, because I would buy assets at pricing that makes that realistic. So we're not transacting a ton of deals right now. We've been having to be either off market in our acquisitions or just very choosy. But the deals we've picked are going to exceed 14%. We'll be at 20 plus on a lot of our deals because of careful choosing. So if you're carefully underwriting, there's enough deal flow for good operators to hit really good numbers for their investors. But it boils down to paying the right price for the right asset.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we are able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before, go to wealthwithoutwallstreet.com/PIOS. There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared though for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
So let's talk about, while we're still in this point number 2, people being maybe overly optimistic about, rent increases. Some of that has to do with supply and demand. I've heard out there, I'm sure you look at this data. That's the reason I'm going to ask you this question. I've heard out there that we have way more demand for homes, and I'm assuming apartments and everything else, housing in general, than we actually have supplies. Why we're seeing building everywhere. Like just next to my neighborhood, there's one of those investor, go in and buy it, put a renter, like they're going to put the renter in there for you. Forget whatever the name of it is.
Build for rent, I think. Yeah.
Build to rent. Yeah, exactly. Yeah. Built for rent or whatever. So are we seeing that in the multifamily space? Is there a lot of demand for new projects, and will that impact the rents for existing properties, or do you not see that? Is it harder, less space, whatever? And so these value add properties are going to actually continue to increase in rent value because there's not enough spots. You got more demand than you have supply.
Great question, Russ. So if I was to generalize and say nationwide, we are undersupplied in housing. So the average multifamily deal is going to go up in value over the next 5 years. I believe that. The prices of homes will rise. I think they'll be higher 5 years from now than they are today because we're undersupplied in homes too. I've been working in real estate since the pre-Great Financial Crisis. I started in 2007. So I saw, we were oversupplied at that time. We stopped building for 6 years. We never really caught up. So we are undersupplied. But if you're going to try and pick winners in multifamily, it goes a lot more granular than that. You could have, we own product, Class A product that is in tertiary Atlanta. So it's outside of Atlanta. Our rent growth is up 15% year over year on a lease up. It's called the Blakely. It's a beautiful Class A product, 420 units that we bought in phases. We bought it for $89 million, good basis price. And I only say that to contrast that with Class A apartments that are in downtown Atlanta that are currently oversupplied and have had rent drops already happen. So if we were to say, hey, in the Southeast, can you buy anything that's Class A and have it have a great outcome? That's not true. It really depends on how much supply and demand there is for your asset class. So I'm in a location with Blakely that's completely undersupplied, where we have corporate housing that they're dying for. We've got people moving out of Metro Atlanta looking for a nice spot which is suburban and offers a lot of amenities. And so when you are benefiting from that, you're going to have rent growth. If you're oversupplied in your micro market, you can't fight the market. Ultimately, every property manager is going to tell you, hey, the comps are at this price. How do you expect me to get this if we have the same product?
I love that. Yeah, it's a great point on the fact that just because we're in a national housing shortage, it does not necessarily guarantee rent growth in all areas. So you have to be underwriting the deal from a local and hyper-local kind of indicator. So that's really, really helpful. Well, I don't know if Russ has any more questions about the rent growth, but I would love to talk more about the operators, like bad operations in general. That's your third point. What are some of those key things that you see are going to potentially implode certain projects or keep them from growing like they should?
I think when you look at operations, like I'm not someone personally who invests in sponsors that don't operate, because I feel like there's just another layer that can be complicated. Now, I'll say that if the sponsor is very well, if the sponsor and operator have a very good working relationship, where by sponsor I mean someone bringing capital into the operator, then it's more of a symbiotic relationship. If someone's just raising capital for random deals, then you really, as an investor, there's nothing wrong with going in with that group, but you need to go one step forward and talk directly to the operator to get an idea of how their operations are. You really talk and vet the operations. That's why when Sharon and I work together and raise capital from sponsor groups, we talk directly to the investor. We don't just talk to the sponsor who then talks to the investor, because we want the investors to know, hey, you're coming in with the group, but you have direct access to ARC, and we will tell you how the asset that you're investing in, what we plan for it, how well capitalized we are on it, how well operationally we are supporting that asset, because it's all about focus. To go one step further on ops, Joey, I would ask the operator that you're working with, how deep is your bench? Because a good operator can become a bad operator if they're spread too thin. At ARC we have 2 people in our operations department, and we have 4 assets that we directly operate. As we scale, we have more manpower than we need, and I'm happy to pay that personally, because that just is a way to make sure we're protected and have really, really good operations. I will always overinvest in operations directly from Sharon and myself. That doesn't come from there's no cost to the investor on that. We bear that cost as general partners willingly, because that's how we protect our investment and also protect our investors. So when I look at operations, it's like making sure that there's more than enough eyes on your individual investment, and making sure that they continue to grow responsibly. And just because they're buying new stuff as an operator doesn't mean that they're not paying just as much attention to what they currently own.
So do you see that, like, that's one reasons why deals potentially may be going bad in the future, is that one, they got into deals with rates that were adjusting, and now they're adjusting at a significantly higher rate. Maybe the property has maybe gone down in value because maybe they couldn't do the construction because of all the lumber prices, right? Last couple of years, it got expensive. I would imagine there's people that went in with the idea of, I'm going to do value add in 2019, and then in 2020 everything halted, and they said, okay, we can't do anything. And then all of a sudden prices of lumber went up for a year, everybody stopped, then rates for everything went up, and they're like, oops, can't do that. Now they're sitting there, that's an issue. Maybe that's hitting them from the rent growth standpoint. But now, as they're operating the project, maybe they went in there saying, hey, we don't need as much in operations because we're going to get out of this deal in 2 to 3 years, and they didn't get out for whatever reason. Now they're trying to expand. Other than those 3 issues, any other things you can think of? Because I guess I just want to continue to inform our audience, right? One of our biggest things is help people become better investors. And I think the more we understand about how these deals work, and most of us at some level have either already invested in multifamily or probably will, because it's the asset class that is the easiest to see and understand. And it's real estate. We all get that part. So what else are we missing that we need to make sure the person listening to this as they're driving down the road knows so they can be a better investor, Robert?
Great question, Russ. A good question to an operator that you're vetting to look to make an investment in is, have you done this before? And they'll say, yeah, I've bought other multifamily deals. It's like, no. Specifically, like, for instance, the one we're buying in Tuscaloosa, the previous owner, who's actually staying on as part of our limited partnership group, he took the property that was in the same property built in 1980. He bought it 5 years ago, took it down to the studs. He's local to Tuscaloosa, and his background's in construction. He turned a rent roll that wasn't. It was actually a rough pocket. He basically evicted everybody along the way as the leases were coming up, redid the complex. It looks like it was built in the last 3 years. It's beautiful. It's now got a rent roll that is very, and when I say rent roll, I mean the tenant base is young professionals. And so he's completely turned things around. As we go in, our value add is that he's not done the greatest job with operations in that he doesn't have on-site management. He's actually managed it himself with an assistant. And so we felt like he left a lot of meat on the bone by not having those operations, as well as certain things like he doesn't have a dog park, he doesn't have a beer garden, like little yuppie features that people like, and that we know based on the comps that we can achieve a couple $100 more in rent growth than he's achieved because of that. By comparison, Russ, if I told you I was going to buy an apartment complex in Tuscaloosa where I was going to take things down to the studs, meaning when I say down to the studs, I mean literally, reconstruct the apartment complex and then build it up, and I wanted you to invest in that, and I hadn't done that before, don't touch me. It's as simple as that. It's like, your money's safest in the bank, right? So it's like, okay, what have you done before in this exact asset class? And people say, okay, well, have you exited it? In some cases, people may not have sold. But in all the assets that ARC owns, I can walk you through where we are, where we bought, where the value is currently, where we've taken the income. So you can see how we performed. And so you just kind of invest in stuff that's similar to what we've already done, because we're less likely to screw that up.
Well, that's a great point, because trust is not always based off of just the person. It's based on the capability of whatever the business plan is, right?
100%.
To your point, there's multiple ways to take down a multifamily asset. And if the business plan is not something that's been achieved before by that person, you're really rolling the dice, even though it's the same person that's maybe had success in the same asset class. It's just a different approach.
100%, Joey.
So that's a great point.
That's why at ARC, we're very focused on the Southeast. I've had investors of mine that have said, hey, I had one investor who's got a lot of money with us. He's like, hey, I own a parcel of land in Oregon, and I have a hotel next to it. And he's an older gentleman. He's like, he was talking to me at lunch, and he's like, and he's got multi-seven figures with us. And he's like, hey, would you guys buy? He goes, I know you have a construction background, Robert. Why don't you build a multifamily complex on there in Oregon? This is a year ago. And I said to him, with all due respect, because you're a valued investor, I have no interest in that project. I'm based in the Southeast. We buy stuff right now predominantly in Georgia and Alabama. And nothing I'm doing is ground up construction. So I'm not interested at all. And he said, that was a trick question. He goes, if you told me that you were going to do that, I wasn't going to invest in your next project. I figured you were scatterbrained. He goes, you gave me the right answer, because he goes, you're not after every dollar, you're after the right dollars. And I think that's important.
I want to ask one more deeper question that I didn't intend to, but the more we're talking, it's reminding me of something. Our tribe, as you know, is all about building passive income today.
Totally.
And there's so many different ways to take down a multifamily asset, and there's different business plans that have to do with that. So walk me through, if someone says, man, I've got a couple $100,000 and I want to get my passive income to exceed my monthly expenses today. I don't want to wait 5 years to double my money. I don't want to just to double the cash. I want to create the cash flow. Walk me through, what is the business plan I should be looking for with an operator?
Great question. So we have 3 ways that you can invest with ARC, and I'll use that as a platform. There's Class A and Class B equity offered on most of our deals. Class A is about 20% of the total equity offering. It'll typically be 9 or 10% paid current, but with no equity upside. So you're going to get cash flow, and it's coming from operations, right? There's no funny business. It's all based. That's why it's only a small portion of the total equity base. We want to make sure that there's enough cash flow in those assets day one to pay that. And so an investor will get 9 or 10% paid quarterly from the time we buy the asset. And that's a cash flow stream. That works really well, especially with those who are retirees, and they just want to make sure they're not so worried about growth. Because our growth model is to try and hit a 2x return in 5 years, which means we're modeling 16 to 20% a year in the growth model. The non-growth model, it's 9 or 10% paid current for the time that we own the asset. That's Class A. Class B is one where you'll get smaller cash flow from day one, because you're sitting behind Class A. You might get 1 or 2% of cash flow in year one. It goes up a couple of points every year. So if we hold an asset 5 years, and you did year 1 2%, year 2 4%, 6, 8, and 10, that would be a realistic expectation of cash flow growth if we held an asset 5 years. But you are getting the equity upside that you share with the general partnership. So your overall return, if you invested a couple $100,000 on a 5-year deal, the Class A investor is going to get, at most $100,000 of money. The Class B investor could get $200,000 or more of growth in that 5 years.
So you're just breaking this down, tribe. If you're mostly after cash flow today, there's the strategy of being this Class A investor that Robert's talking about, where it's just I'm getting monthly the highest amount, quarterly, the highest amount of distribution on that money. But I don't have any way to gain on the sale of that property. So if they double the value of the property in that next 5 years, I don't get any of that, because I've chosen to trade that for quarterly distributions at the highest interest or highest rate possible. Yep. But if I want a smaller monthly or quarterly distribution and then the upside, then there's an option for that as well. But the point I want to make is not necessarily Robert's deals and specific to that. But these are questions that if you're going to invest for cash flow, for financial freedom, you need to know what those options are. You don't just need to assume, oh, I like the operator, I like the property, and I'm going to invest. It needs to also align with who you are as an investor and what your ultimate goals are. And so thank you for breaking that down, Robert. I think that's super valuable for people to understand.
And we do have investors that do both, Joey, where they might put $200,000 in with us. They'll put 100 in a Class A, 100 in a Class B, and they'll get a blend of that. And therefore, they're getting the cash flow, but they're also getting the upside. Man, and then we also have some, from time to time, we have debt instruments as well.
Robert, this is amazing. Thank you for coming in and just drilling down into the nitty gritty, because I think this is what helps people win. If somebody wanted to connect with you, where would you tell them to go?
They can go to our website, arcmf.com. They can also hit me up directly via email. I'm Robert, Robert, at arcmf.com. And then we are, like I said, we are working with Russ and Joey to bring a upcoming deal, ARC deal, to Wealth Without Wall Street. And so they can also come in directly with you guys and let you know that they have an interest in a future offering that we have. And then when we put together something together in probably second half of this year, they can participate in that and look to come on board if it's a fit. For us, it's about education, candidly, just like you guys. If someone comes in a year from now, 2 years from now versus right now, it makes no difference to us.
Love that. Thank you so much, man. Really appreciate you. Tribe, take action, right? Like, do the research, ask the right questions. If this is something that you're interested in, follow up with Robert. We'll make sure all the links are in the show notes. But also share this with somebody else. The way people learn, the way you get better is being around people who are making you better, right? So hopefully you're already in our community. If not, go to wealthwithoutwallstreet.com/community and join. But also bring others in there with you. You can hit the invite button inside your app and connect with people and say, hey, come in here. This is where we're talking about how to build passive income that exceeds our monthly expenses. This is how we're rubbing shoulders with the Robert Pereiras of the world, who are the people that we want to know more about and what they're doing so that we can be more like them, right? The better you are, the more people you have that are where you want to be, the more likely that's where you will get to. So please share this with other people. Robert, again, thank you for being on. As always, thank you for listening. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.